Um, Oil prices have skyrocketed to a multi-year high, but that's unlikely to benefit the S&P 500 earnings as much as they used to, says the Bank of America. So, welcome to supply and demand, Trump sycophants. One factor serving as a tailwind is oil exploration companies that have tightened the spending. The U.S. oil prices have jumped more than 70% this year, with the oil market in a deficit. Now, oil prices have jumped to multi-year highs, and such moves tend to bolster the S&P 500 index. But budget tightening by U.S. oil companies and other factors are doling the boost that the latest crude spike can have on the benchmark. This conclusion comes from Bank of America in a research that was noted on Friday. Historically, the higher oil prices have translated to higher earnings for the S&P 500, especially following the shale revolution in the U.S. The Sabita Subramian or whatever, head of the U.S. equity and quantitative strategy at Bank of America, said in the note. But the shrinking size of energy beneficiaries in the S&P 500 and capital discipline by oil explorers and the producers stand to undercut the positive impact of the surge in oil prices on the index, the investment bank said. Every 10% rise in oil prices that's used is to translate into a 5% increase to the S&P 500 per share. In part as it led to increased capital expenditures that helped the oil servers company. Oil prices this year have surged as easing COVID restrictions boosted energy demand, contributing to a supply deficit. The West Texas Intermediate crude oil futures have climbed more than 70% this year to trade at a 7-year high, above $83 per barrel. Brent oil, the international benchmark, has reached 3-year highs, gaining roughly 65% in 2021. Basically, they're topping $85 per barrel. The investment bank's commodities team projects the Brent prices to rise above $100 a barrel if the low stockpiles and a rebound in air travel collide with the cold winter. But the last time the oil was above $100 a barrel was back in 2014. The landscape was much different and no longer has the same trickle-down effect. But back then, the oil beneficiaries like Energy Select, industrials, and chemicals represented 20% of the total S&P 500 earnings, BOPA said. Today, that number is just about 6%. Also, the oil E&Ps have tightened the capital discipline, with the number of active oil rigs remaining more than 50% below the prior peak. With oil at $80 per barrel, both those oil services analysts expect a roughly 22% increase in capex at the E&Ps in 2022, but that's still 23% below the 2018 level. This translates to less revenue for energy capex beneficiaries and a lower earnings multiplier from higher oil. The energy earnings will also be driven mostly by higher prices rather than the price plus volume. So if you like the video, give the video a like and subscribe to my channel, RBW King, and also hit the notification bell so that you'll be notified when a new video comes out, and thanks for listening.